Hey, good morning. This is Mayor Vilensky with Driving Markets. Quick caveat, obviously anything said on this video is an opinion and you don't necessarily have to follow it. It's my opinion and it's there just to give you some information and a balance of what's going on in the marketplace. So let's start. So the retail sector in the States, which is the economy that's driving the world, still we can't avoid that economy, we can't ignore it. What happens in the US affects the whole world. Retail sales again are up. Retail sales are beating analyst expectations, and yet the markets went down. Why did the markets go down? As I said yesterday, and I've said recently, as long as there is a rising price pressure, then you're going to have higher inflation. And yesterday, the market woke up and said, wow, sales are going through the roof. People are ignoring the underlying pressures of inflation, which is taking and reducing the real purchasing power of their money. And as a result, the market said, wow, this is going to add more pressure to inflation because retail sales are going up. And as a result, you're going to have, at some time in the future, the central bank waking up to high inflation and will affect interest rates. We cannot ignore what central banks will do. They will, at some stage, whether it's going to be in a month, 2 months, or 3 months, they will start to raise interest rates. And those rising in interest rates, whatever size they are, will affect the overall economy and will affect stock markets. It'll affect stock markets on the basis that if it is a one-off rise and no intention to raise interest rates again, then it won't affect stock markets. However, if it's going to be a trend of increasing interest rates and the statements that the central banks come out with will be ongoing monitoring and ongoing raising of interest rates, then that will affect overall pricing. And one of the markets that will be significantly affected is the NASDAQ. So my opinion, and I'm saying now, that if interest rates rise, the NASDAQ will be affected because the NASDAQ is all high tech and high tech is all speculative. And when the risk premium or the cost of that risk premium is greater, then people will move out of the NASDAQ, so they'll sell their shares, reduce their holdings, and they'll move into fixed income securities. Fixed income securities are securities that pay an interest, whether it's bonds, whether it's cash on the bank account, whether it's national savings, things that pay fixed interest rates, that would attract the money. Remember, there's continuous competition for capital, continuous competition where to put their money and who wants your money. So whoever gives you the best return, those are the ones that are going to attract your capital. So be aware and be alert to inflation. As long as retail sales are going up, there is an underlying pressure on inflation, and that's excluding the cost of commodities. I would, in my opinion, probably expect markets to fall further or become more nervous going forward, and therefore, considering they've peaked and now they're just below their all-time highs. Yesterday, again, the S&P touched it, matched its all-time high, and then came off. You've got to be aware of that, and you've got to be very, very, very clear in your trading strategy. Remember, trade small amounts with a large amount of money on account, and that will allow you to ride out the storm. Do not get pulled in by increasing your position and finding out that once it turns around, you'll end up losing all your money. Finally, only trade with regulated firms. As I've said over and over again, only trade with regulated firms. Firms are regulated in Europe or regulated with FCA in the UK or in the States. Wherever you're trading, make sure they're regulated firms. I'm happy to speak to you regarding anything regarding trading if you need any help. One question was asked yesterday, what's going to happen with the infrastructure bill in the States? Well, the infrastructure bill in the States, which is $1 trillion, is probably going to add more to underlying inflation because there's going to be a lot of purchasing for the builders and the suppliers that supply the building industry, and that's again going to have a big push on demand. As a result, prices will probably rise, and there'll probably be another tick up in inflation just based on that $1 trillion going to the rebuilding of the infrastructure in the United States of America. So this is Mayor Vilensky with Driving Markets. You can contact me on LinkedIn, contact me on WhatsApp, contact me on Instagram, Vilensky Mayor, contact me on YouTube. Pass a comment on the YouTube. It'd be very nice to see some comments on the YouTube. Hope you're enjoying this production. Speak to you soon, and I'll do another one tomorrow. Please God, all the best.